Welcome back. I'm Mike Santoli, and it is time for Trading Nation. The safety trade acting anything but safe right now. Defensive sectors like healthcare, staples, REITs, and utilities plummeting over the past week and offering no real shelter as the sell-off intensifies. So is there nowhere to hide? Bill Baruch of Blue Line Futures and Stacey Gilbert of Susquehanna join us now to discuss that. Bill, first of all, what's your read on this pattern here? Does it just mean that it's indiscriminate selling? Folks are just kind of getting rid of everything and therefore not really discerning between safe and not safe?
There's been systematic selling across the board for about 2 months now. You're seeing the death cross from index to index. You're seeing a portion of the Treasury yield invert. You're seeing the Dow take out February lows. You're seeing the NASDAQ get near February lows. But ultimately, I did not predict this last leg in the market. That's okay. I've been pounding the table on being long Treasuries. So if you're long the REITs or long utilities, the broad market's going lower. They may outperform, but you're still going to lose money. I like being long Treasuries. I'm looking at the TLT, and there may actually be a golden cross down the road where you get the 50-day moving average move out above the 200-day. If it can hold out above 119 in the TLT, it broke a long-term downtrend from 2016, and I think there's upside here to about 127. The same way the 10-year yield has broken down its downtrend line, and the 10-year yield, I think that can get down to 250 now.
Yeah, that's a more pure version of a safety trade. So, Stacey, with those yields going down, wouldn't REITs and utilities and staples also be relative beneficiaries?
Yeah, certainly with those yields going down. Mike, you asked a question about the indiscriminate selling, and I think that's a really important point because I do think that's actually what we're seeing out there right now. And it's not necessarily indiscriminate selling as much as it's a buyer strike. And I think we just need to be aware of kind of where we are in the cycle, where we are in the year, and that we're really just seeing a lack of buyers rather than a seller-driven sell-off here. And I think that's incredibly important because you don't want to change whatever your thesis is just because of some of these gaps in the marketplace here. If your thesis is longer term, 1 year, 2 years out, this could be a great time to look for individual names. So if you're moving to a more safe type of portfolio, I would look for the names that seem to be disconnecting in the market right now rather than change that entire thesis. And I do think that there are opportunities out there. And as if we talked before, there are potential gaps in the marketplace. We're seeing those gaps. And I do think the idea of picking names, being more of an active manager as we enter the next 2 years is going to be incredibly important. So I would look to use this opportunity for a buying opportunity for the names that you've been waiting for.
All right. Yeah, air pockets in an illiquid market near year end. Maybe that's exacerbating what we're seeing here on the screens, guys. Thank you, Bill and Stacey. Appreciate it. For more Trading Nation, head to our website or follow us on Twitter @Trading Nation.
In a losing trade, avoid letting your emotions get the best of you. Too often, traders want to add to a losing position, but experienced traders will say your first loss is your best loss. In other words, take a small loss and move on before it becomes too big.